Hi everyone, welcome back to my channel. Okay, so today's video is a walkthrough for 2 repeatable intraday setups any trader can master. And that'll be the bull flag for momentum continuation and the rising wedge for distribution setups and reversals. So I'll cover how to identify each pattern, the exact clues that separate real setups from the noise, the step-by-step trade structures, and I'll also go into detail about how to size and manage risk with option considerations and why new traders can benefit from using these guidelines consistently. So let's go ahead and jump straight into it. As y'all can see here, I have Google pulled up here on the left side of the chart, and I have JPM pulled up over here on the right side. Now the first pattern I want to discuss is going to be here on the left side with Google, and we're going to look at the bull flag. So of course I want to spend some time talking about what it is and how to spot it. So with that being said, I'm going to zoom in just a little bit more. And I want to briefly discuss the pattern anatomy. So I'm going to go ahead and pull up the drawing tools right here, and I'm going to select this so that you can see the actual drawing for it. Now I have traded the bull flag pattern several times, and I'll leave some links for those videos down below. It is a pretty consistent pattern for me, so it does usually play out in my favor, just simply because it's super easy to spot. So the first thing you'll always notice with any sort of bull flag is that they'll start with a flag pole. Regardless if it's pre-market, post-market, or during the actual trading day, you'll see some sort of uptrend to start. Now the flagpole in a sense is typically going to be a fast clean jump of the stock forming higher highs. So you'll see a sharp series of bullish candles. And this is driven by clear momentum and expanding volume. Now the flag itself is pretty compact. It's mostly going to be a parallel downtrend within a horizontal channel that forms after the run. And the price pretty much fluctuates between the two trend lines. So for example, you'll see here is the start of the bearish momentum. So in this case, you'll see the rejection goes all the way down to about 8:46 a.m. So if I were to go ahead and draw this out for the visual, you're just going to simply connect what you see as far as the candles as they flow within this diagonal downtrend. So that's essentially the bottom of the flag. And then when you connect it to the top, you're usually just staying within the channel as far as what the stock is showing you. So from here, you'll see that the candlesticks are for the most part staying within this parallel downtrend. Now, is it perfect within this? No, but you'll also see it repeated once again here as well. So for this specific example, at about 9:08, we can see that the sentiment shifted to bullish, and this is essentially how we would form the flagpole. So from here all the way up to this candle at about 9:22, and then with this bearish candle here as a rejection from about here, all the way down to about 10:04 a.m., this is actually forming the flag. So I'm going to go ahead and keep it within this channel as well, and you will see this forming the horizontal move of the downplay. Now, generally within this, you'll see that there's a volume profile. Now, this is typically where you'll see strong volume on the flagpole, as you can see here. And that's also reflected here as well. Within the flagpole, you can see stronger volume. Then you'll see a significant drop in the volume during the flag consolidation, which is this room here. So it can remain at least moderate or somewhat stagnant within that. And you can see that reflected here at the bottom with the volume. But then there's a quickly renewed uptick on the breakout, and we can see the volume increase here. Now this works on multiple time frames. Obviously I'm on the 2-minute here. You can use it on the 1-minute, 5-minute, 10-minute, anything you choose for your intraday scalps. You can even use like the 15-minute if you're looking for swing trades or larger scale intraday moves. Now the high probability clues on this are, one is that the flag retracement is shallow. Typically for the flag, you'll see anywhere from about 40 to 50% of the pole is at a healthy level, and this helps to have the consolidation at a deeper chop for the weakness of the edge. Now generally candles that are inside the flag will have smaller bodies, with the exception of certain candles here or there. For instance right here, when we see these weaker bearish candles, this does show that sellers aren't as aggressive. And what typically will give you the biggest clue that it's going to be a breakout is the first set of candles that follows the last bearish sentiment. So a breakout candle that closes above the flag's upper trend on rising volume, and that's basically when it prints at or above the asking price, this can validate the entry. So for instance, we can see this set of candles here in this 3-candle sequence is bullish, but the momentum is very strong. And on the second candle, it closed well above this candle right here. Now, a good tip is that confluence with VWAP or a prior support turn pivot strengthens the setup. So how to trade a bull flag is, one, you want to make sure that your entry is somewhat aggressive. So whether you're deciding to buy at the market or a limit, you want to also make sure that there's full confirmation for the breakout above the flag with volume also backing it. It doesn't have to be an excessive amount of volume, but you definitely want to have it higher than what it was on the previous when we've seen the consolidation within the channel. Now personally, I prefer a close above the line on the chosen time frame that I'm selecting, but it doesn't always have to play out that way. But in this case, we can see that it clearly did because this candle at 10:04 closed above the channel's ending. Now, if you're wanting to be a little more conservative with your trades, you can wait for a retest of the breakout, and this is when price reclaims the upper line or VWAP, and you can take a limit fill there. It's good to always make sure you place your stop below the low of the flag or a fixed ATR multiple. So that way on the time frame that you're trading, you're making sure that if you do get stopped out of the trade and it continues to reject, you don't have to worry too much about it because you won't be risking too much of your capital. Now your targets, on the other hand, these are measured moves at the height of the flagpole itself. Now this is going to be the added breakout point. For day trading, also scale out to lock in profits early as it continues to excel above the range in which you selected. So basically what I'm saying is that position sizing is going to help with your risk per trade. So if you're a brand new trader, your account risk is typically not going to be more than 10 to 15% on a trade. So you want to make sure you size your total premium at risk for equals for your intended dollar amount that you're risking. Now keep in mind when you're using day trades, you want to use near-term calls for weekly with good delta. I always recommend choosing a delta of a 0.5 or greater, and that just allows for you to have a cleaner stock-like behavior. And then when you're looking at swing trades, you can buy calls with a DTE of 30 days plus, and that will help to reduce the gamma and time decay pressure that you're under. And if you're more advanced, you can definitely consider using like vertical spreads to define your risk if the IV is elevated. One of the main reasons why this pattern works so well is that this flag is a pause in supply absorption. And essentially all that means is that volume contraction signals sellers aren't committed. So the breakout shows that buyers resumed control. But keep in mind that execution discipline, whether that's entering on confirmation or if you have a disciplined stop, this turns this into an edge for your trading strategy. Alright, so now that I've provided that full breakdown, I hope that makes sense. So let's go ahead and take a look at the rising wedge pattern. Now what the rising wedge is and how to spot it, we're going to go ahead and take a look at the anatomy. Now this pattern on the other hand is going to start as a converging uptrend. Price is certainly going to make higher highs and higher lows, but within a narrowing range. Now trend lines converge upward as you can see here. So let me go ahead and zoom this in just a little bit more so y'all can see this better played out. Now the signature for the most part within this pattern is you'll typically see that the volume will actually decline during the wedge formation because buyers grow less enthusiastic as the range compresses. Now momentum divergence is basically a confirmation. It could be like the RSI, MACD, or if you're using any other type of momentum oscillator. If this fails to make corresponding highs while price does, that's a big clue of what's going to happen next. Because context truly does matter in this case. So if I were to go ahead and draw this out for the visual look, essentially you're just taking a look at the candles forming these lows within the channel all the way up until you see a high. You're going to see that the candlesticks form this sort of consolidation in an uptrend, kind of similar to what you would see with the bull flag, but obviously in the opposite direction. The top part is pretty easy to spot as well. You're just going to go ahead and draw it from the top to the bottom as you'll see. And you won't see all candles stay perfectly within the channel. However, for the most part, you can see them consolidating within this range. Now, one of the major reasons that I'm saying context matters is because a rising wedge and a sustained uptrend, it often signals distribution and a likely reversal. Now, the high probability clues within this pattern are again going to be one, the decreasing volume. So the move lacks real conviction. There'll also likely be a failed attempt to break higher highs, which is basically like a false breakout. And you'll see that here at this candle at 10:20 a.m. Now, this is usually followed by an immediate rejection, and it's a strong prelude to the breakdown. And you'll notice that here with this bearish candle at 10:22 a.m. Now, confluence with overhead resistance or a prior supply zone, it increases the probability of a meaningful sell-off. So now when we look at how to trade this, if you're one that's more on the conservative side, wait for a clean break below the lower wedge trend line on increased volume, hence what you see here. And you can enter short on a close or the retest of the broken line. Now, if you're one that's more aggressive, you can enter on a failed breakout above the upper trend line, and that will be exemplified here at 12:18, because this is going to show you that it can reverse quickly. Now, be fully aware that this does trap buyers from time to time. So you want to make sure you place your stop above the recent high or above the upper trend line using the ATR for any type of sizing. Now your targets can be measured based upon what you choose. However, you want to make sure the move equals the vertical height of the wedge at its widest point projected down from the sell-off. And consider partial profits at the first support, and this is going to be like a bank at the 2 R&R if you're wanting to trade that. Now, in regards to position sizing, the same risk per trade rule does apply, so you want to convert to shares or contracts based on your account size on the dollar risk allowed. Now, for option structures, for short term, you want to buy puts or spreads with sufficient delta for fast intraday breakdowns or debit spreads with limit risk in the cost. Now, if the IV is high, personally, I prefer spreads to avoid paying full premium into rich IV. Now, sellers could use bear put spreads or ratio spreads, but only if comfortable with assignment in the margin. Now, why this specific pattern is usually very profitable is that the wedge shows diminishing buyer enthusiasm. So once sellers begin to step in, the stops above prior highs cascade, which basically just amplifies the move. Now, the clearest winners are traders who catch the initial breakdown or the retest with disciplined stops. So to add to this, you do have to be very strategic. For me, y'all have heard me say it time and time again, that volume rhythm is the single most reliable truth teller in a lot of cases. And expanding volume confirms commitment, while contracting volume during consolidation suggests a lack of supply or demand. Now, the candle structure will always reveal the truth of what's the real intent. Long wicks on rejections or big real bodies on breakouts and even failed breakouts are red flags. So momentum divergence often precedes price failure. So I like to use it as an early warning to tighten stops, or in this case, to prepare to go short on the reversal. Now, to put this in context, where the pattern forms relative to the major pivots, it could be the VWAP, moving averages, or any type of like market internals, because we know how SPY and QQQ react. This matters more than the pattern alone. So if you're just looking at formulating a trade plan, the obvious thing to know is that you want to review this pattern over multiple occurrences. And you should also view this on multiple different time frames. So define your entry rules for the bull flag by simply having the breakout candle close above the line at least 20% higher volume or retest the buys within 1 to 2 of ATR. Define your exit rules explicitly to have a stop placement, and then scale your rules as well. So you could take at 50% for your R&R, 25% at the next level of R&R, and just have it to play out as it moves in your direction. Now for your execution method, you want to choose either the market or the limit orders. It's just your choice on that. Logically, if you prefer the limit entries on retest, the stop limit on breakouts to control the slippage can play in your favor. But you want to practice this within the simulation just to calibrate the fills. So let's say you're tracking your trades with the pattern snapshot, and let's say it's volume or RSI. If you're looking at your entry and your exit with slippage in the outcome, you want to revisit it after 5 to 10 trades just to refine your rules on your trading plan. And then make sure that your risk to reward is going to make sense for the considerations that you have set. For bull flags, I recommend at least a 1.5 to a 3 R&R if the measured move aligns with the momentum. And then for rising wedges, I would recommend anywhere from a 2 R&R plus on strong breakdowns. Now always remember, time decay for options is a main thing to consider. For day traders, of course, if you're using short DTE but accept higher gamma, that's totally fine to do. Now for swings with the DTE of the range of 30 plus, to avoid time decay erasing your edge, make sure you're choosing a strike that will correlate best to the trade. Now this brings up the point of slippage and spreads. So on thin tickers, wide spreads make small edge trades unprofitable. So you may prefer liquid names for intraday application. Now specifically why new traders benefit from these patterns is the clarity and the repeatability of them. Both patterns give less guesswork to do and fewer emotional mistakes. Now, risk discipline is built in because the pattern-based stops are objective by design, so new traders learn to accept small losses and protect capital, which is what I particularly like about these. Now, it also allows for faster feedback because day trading these patterns yields many more trade opportunities because they are so repetitive, which in turn helps to accelerate the learning when combined with tracking and replaying the practice over and over. Now, what matters most is the highest value focus areas. So again, make sure it has clean structure, a textbook flag, or a wedge, because these are worth more than a dozen sort of patterns. You can just wait for the clear confirmation. But just keep in mind, you don't want to trade the pattern without proper volume behavior. It literally is the difference between a valid setup and a trap. So execution quality is the top priority. Your entry type, whether it's a breakout versus a retest, the order type, it could be like the timing to determine the profitability, If you're new at this, just practice until your fills are consistent. And then just use really strong risk control so that you have strict stop placement and sizing. So you just want to avoid hope-based holding to protect your capital first and then have your target second. Now, the final thing I like to discuss in these types of videos is, of course, the practical usage. So because of that, make sure that the pattern matches the visual criteria, meaning it must have all factors. In this case, it needs the flag pole and the actual channel, or the rising wedge within the consolidation of the channel. So it could be like the shallow retracements or converging rising highs and lows. Now, when the contraction during the consolidation shows the expansion on breakout versus the breakdown, this shows the full alignment to the trade being consistent with what you see for the pattern. And that's always going to be backed by the momentum either confirming that it's a bull flag or diverges for the rising wedge. And you can always use the ATR as a buffer if you need it for these types of trades. Alright, so if you're just starting, it's best to master one pattern at a time. So you can start with either one of these. Make sure you're also trading liquid stocks and ETFs, so SPY, QQQ, Apple, Nvidia, of course, Google. And then build a 10 trade sample in simulation. Then move to a small live size once your win rate and average R&R match your backtest. And then use the wedge as a complementary shorting strategy once you've internalized volume reads and divergence cues. The system wins, y'all. I'm telling you, guesses don't. So keep the plan tight and let consistency compound. So yeah, y'all, these are all the main things I wanted to discuss. And with that, that'll pretty much do it for this video. Y'all already know if you found any of this information to be helpful, feel free to leave me a comment down below. I thank y'all so much for watching. And as always, of course, I'll see y'all in my next one.